People really don't know what their expenses will be because they don't know how long that they're going to live.
Americans are worried they won't have enough saved for retirement now more than ever.
Retirement is going to cost, for many folks, over $1 million.
Is no sure thing in investing, but a lot of people think that annuities may come close to that.
It's going to more safe things that they know. If they know they're going to need that money to supplement their retirement, well, then you can't play that risk.
This is the Safe Money and Retirement Show with Jon Heischman Sr., founder and partner of Heischman Financial Services, serving the Columbus and surrounding areas. Jon specializes in educating pre-retirees and retirees about safe money strategies and ideas. Now, it's the Safe Money and Retirement Show. Here's Jon Heischman Sr.
This is Jon Heischman, bringing you the Safe Money and Retirement Show. I appreciate you taking the time to join me. I thought it would be appropriate to start the show by giving some year-end tax planning ideas. We have all strived to minimize our taxes all year. The good news, here are some year-end strategies that may help cut your tax bill even more. Now, it's very important before implementing anything to do with taxes, please check with your tax advisor. One idea, defer or accelerate income. Here we're going to project whether you have higher taxable income in 2024 or 2025. If it's 2025, investigate receiving your employer bonus, investment, or any business income this year, if available. Do the opposite, for example, if you expect to lose a dependent. Maybe your spouse is going to take a leave or suffer business losses, and the result will be you'll have less taxable income in 2025. As far as your deductions, if medical expenses for this year exceed the deductible minimum threshold at 7.5% of adjusted gross income, squeeze in a medical expense that you were planning to have in 2025 so you can maximize tax 2024 savings. Before bunching any tax expenses into this year, consider your overall tax brackets for this year and for next year. Let's say you anticipate income increasing enough next year to put you in a higher bracket. It might make sense to postpone a deduction. Those of you that have a health savings account, remember you've got until April 15th of 2025 tax filing deadline to make health savings accounts contribution for this year. If you haven't already maximized your contributions, do so. HSA contributions and earnings are generally excluded from taxable income. Distributions aren't taxed if they're used to pay qualified medical expenses. Other requirements apply, such as being enrolled in a high-deductible medical plan. For planning purposes, compare the 2024 and new 2025 inflation-adjusted limits. Here's the limits for 2024. If you're an individual, $4,140. A family, $8,300. And there's additional catch-up for those age 55 and older of $1,000. Next year, that individual limit is going to be $4,300, and the family limit is going to be $8,550, and you still get that $1,000 additional catch-up if you're 55 and older. Personally, I really like the HSA concept, and if you haven't used it, you haven't needed to use it, well, you're fortunate. Keep contributing and build that up as much as possible because it's really going to benefit you later on in retirement. And be sure to let me know if you don't have an HSA or possibly you want more information about that. Those of you that want to do and can contribute to charity, review your 2024 charitable gifting effectiveness and potential tax benefits because it may minimize this year's taxes and help significantly impact 2025. Make sure this year's expenses were reasonable based on you and the charity's timescale for change and the nature of the work. Consider how giving more might increase the impact and, of course, reduce taxes. Now, if you're retired, check out this option for increasing 2024 gifts. It is a direct individual retirement account distribution to charity, excludable from income tax, and it can satisfy your required minimum distribution for 2024. Those of you that don't need your required minimum distribution and want to donate to charity, you can take advantage of the qualified charitable distribution, IRS approved, where your required minimum distribution amount or a higher amount, actually it's up to $100,000 that you can contribute. And because you're contributing to a charity, you pay no tax on that distribution, again, up to $100,000. Keeping your taxable income lower may reduce the impact to certain tax credits and deductions, including Social Security and Medicare. Wherever your IRA account is, as far as what company is managing the money or who is the trustee, make sure your plan can be qualified to be able to do that. For example, one of my very best clients recently contributed $50,000 to a foundation for this year's distribution. Now, we set up her plan to where next year she can contribute more, or she can contribute less, or she could take the minimum distribution, which would be much less than the $50,000. She could take the minimum herself. I like the flexibility of this option, and we made sure we had the right company that was able to do that. And one thing I do want to add about that is the charity must be a 501c organization eligible to receive tax-deductible contributions. I believe there are some charities that may not qualify, so we want to make sure that they do. So it's a great plan to be able to cut taxes on your IRA accounts. For more information, feel free to contact me, and I'd be happy to supply you with more detailed information about the qualified charitable distribution. 888-426-0177. That number again, 888-426-0177. I can send that information along with the book I sponsor, Top 10 IRA Mistakes and How to Avoid Them. It's been a very popular book, easy to read, easy to understand, and it's yours for the asking, no obligation, and no cost. 888-426-0177. Also, for those of you that want to start your planning or review your plan as to what you've done to date, but you're not quite ready to contact me, I can add you to my monthly newsletter mailing list. It's called Let's Talk Money and provides a lot of ideas and strategies geared towards retirement. No cost to radio listeners. It's my complimentary gift. And when you're ready to either meet or have questions for me, you can give me a call in the future. Just request to be put on my newsletter mailing list. After the break, I'm going to introduce to you another concept, how to create a tax-efficient legacy with predictable lifetime retirement income. So stay tuned. I'll be right back.
Thanks for listening to the Safe Money and Retirement Show with Jon Heischman. For more information, call 1-888-426-0177. That's 1-888-426-0177. Or visit their website at HeischmanFS.com. More of the Safe Money and Retirement Show in a moment.
Avoiding mistakes can save owners of IRAs, 401ks, and TSP plans, as well as other retirement plans, a fortune in taxes, penalties, fees, and loads. These potential mistakes are addressed in the free book entitled Top 10 IRA Mistakes. This is Jon Heischman from the Safe Money and Retirement Show, offering a complimentary copy by calling 888-426-0177. Again, that's 888-426-0177.
Welcome back to the Safe Money and Retirement Show with Jon Heischman. To contact Jon, the number to call is 1-888-426-0177. That's 1-888-426-0177. Once again, here's Jon Heischman.
Welcome back to the second part of the Safe Money and Retirement Show. I'm your host, Jon Heischman. As I was mentioning, the end of the year is not only a great time to look at some tax-advantaged strategies, but it's also a really good time to review your financial plan and your retirement plan. Is it on track to meet objectives and goals? Take a look at the accounts that are going to generate retirement income, review Social Security, and take a look at where you are on your pension plan if you have a pension plan. It's actually a pretty easy and simple review, but the big thing, it gives you peace of mind and comfort to know that you're on track. I have simplified that process. So I welcome the opportunity to be able to work with you on that review on a no obligation, no cost basis. Here's the number, 888-426-0177, 888-426-0177. As my regular listeners know, I always enjoy giving ideas, concepts that are going to help you with your retirement plan. Many you've heard of, but there's a lot that you haven't. And one I am going to talk about that I would bet most of you have not heard of is what we call annuity arbitrage. If you're near retirement or in the early stages of your retirement, the balance between growth potential and risk becomes crucial. Annuity arbitrage is a financial strategy that involves leveraging the guaranteed income generated from an annuity to fund the premiums of a life insurance policy. So you may be thinking, why purchase a life insurance policy at this point in my life? Well, properly structured, it can create a tax-efficient legacy, while at the same time providing a secure, predictable income during your lifetime. Here's how it works. Purchase an annuity, and I'm referring to the type of an annuity that's called a fixed indexed annuity, which provides regular guaranteed income payments for the rest of your life. Then fund life insurance with part or all of the income generated by the annuity to pay premiums on a permanent life insurance policy. This life insurance policy, it builds cash value over time and, more importantly, ensures a tax-free death benefit for your beneficiaries. If your beneficiaries don't take this benefit as a lump sum, it can be paid as income, which is tax-free. Very important. Next, it creates maximum wealth transfer because the life insurance death benefit is designed to be larger than the original amount that was invested in the annuity, effectively creating a significant, tax-efficient financial strategy. I think that this strategy is particularly advantageous when using qualified funds. When I say qualified funds, I'm referring to IRAs, where the funds are subject to taxes when withdrawn. Keep in mind, if death occurs, the account value of the annuity has to be paid to a beneficiary as well. So there's an additional death benefit. The beauty of annuity arbitrage lies in its ability to provide a stable income stream while simultaneously amplifying the wealth passed on to your heirs or donated to charity. In this scenario, it flips a potentially inefficient tax scenario into a powerful estate planning tool. I think it's a great concept for the right individual. But for some reason, as I mentioned earlier, most people are not aware of annuity arbitrage. So earlier I mentioned funding this concept with qualified money or IRAs because a significant amount of wealth is held in qualified funds, such as IRAs or 401ks. Over the years, while we were working, contributions were made to IRA accounts. Most everyone has a 401k or similar with their employer. So naturally, qualified money was created, resulting in most wealth being in qualified money. This money normally will be spent down or given away, either intentionally through some type of systematic withdrawal or unintentionally through required minimum distributions, whether it's at age 73, 74, or 75, something is going to have to happen. Since that money will be distributed, it won't be part of your assets that you have under management. And right now, today, that initial investment in the annuity can generate substantially more income. Now, this is going to allow you to fund a more significant life insurance policy. It's the ideal arbitrage scenario. You can secure a significant guaranteed income from the annuity while simultaneously locking in a low premium on the life insurance policies. At the same time, rising interest rates have driven down life insurance premiums. Now, what's the result of this? Greater cash value gains inside that life insurance policy. That means you can get a larger tax-free death benefit for your beneficiaries. These conditions are creating a lovely arbitrage, all funded by the same amount of capital that would have produced far less than a few years ago. So when we get into estate planning and how annuity arbitrage applies, estate taxes are going to touch a lot more people, creating more opportunities to help families transfer wealth efficiently. An annuity arbitrage strategy now, you can effectively move assets out of a taxable estate into that life insurance policy, which, as mentioned, is going to pay that tax-free benefit to beneficiaries. So really, if you think about it, you're really moving money from one pocket to the other to maximize a client's estate. And anytime we can do that, it's a good thing from a tax perspective, growth and protection. Think about the annuity arbitrage. How would it apply to your situation? But maybe you don't know. And that's very typical because, as mentioned, this is probably the first time you've heard of annuity arbitrage. Now, it's my job to see if it's a fit for your plan, to give you more information, details on how it applies to your situation, and it may not. And if it doesn't, I'm going to be the first to let you know this won't work for you and give you the reason why it won't work. But if it does, I'll work with you as far as how to fund the annuity that provides that guaranteed lifetime income and the other details that I've reviewed. 888-426-0177. That's the number to reach me. That number is available 24/7. Leave your message and I'll contact you. Again, that number is 888-426-0177. I can't believe I'm out of time for the show today, but be sure to tune in next week because I'm going to have more ideas, more strategies that will help you in your retirement planning. I'm Jon Heischman, bringing you the Safe Money and Retirement Show. Thanks for joining me. Have a great week ahead, and be sure to tune in next week.
The Safe Money and Retirement Show with Jon Heischman Sr. To get in touch with Jon, call 1-888-426-0177. That's 1-888-426-0177. For more information about Heischman Financial Services, visit their website, HeischmanFS.com. That's HeischmanFS.com. Join us again next time for the Safe Money and Retirement Show with Jon Heischman Sr.